So, I say it and I'll say it till the day I die, Class A products still win. Even in slower markets, it solves operational problems. Higher clear heights reduce racking costs, better dock configuration reduce turnaround times. There's all these various factors. We also put a huge focus on site flow, safety, energy systems, and the architectural design. That is huge for us. We put so much time on making our industrial buildings sexy, not just to be appealing, but there's benefits of that to the people who work in these buildings. Yeah. Even in a slow market, quality outperforms.
Hello and welcome back to the Espace Montreal Podcast, a show dedicated to commercial real estate right here in Montreal. Today, it's a pleasure and an honor to have Mr. Mike Jager back on the show. Mike is the co-founder, co-president of Rosefellow. Hey, Mike, welcome on the show.
Thank you, Axel, so much for having me. Really appreciate it. It's been a long time.
It's been a long time. So we were just discussing before we started. You were on the show, I think, 3 or 4 years ago.
That's right.
I remember we had a very interesting and inspiring conversation, and I invite everyone to go back through the episodes and go listen to that one first if they want to. And so today, we have a lot to talk about. Basically, the last year has been a challenge for the industry.
That's right.
Rising rates, the relationship with our southern neighbor, and all the impact that it's had on manufacturing and on the business sentiment. How has it been for you?
I think the reality is that the first 7 months of the year were challenging for everyone.
Yeah.
You're dealing with vacancy rates that rose mainly because of 3 factors: slower tenant decision making, the uncertainty with the U.S. tariff talks, and a financial environment that made new deals harder to execute. As simple as that. The good thing is at Rosefellow is that most of the vacancies generally in buildings that are Class B and Class C. The interest in quality product is still there.
Okay, so that's because you build a lot on spec. You've had
everything is on spec, unless at the very last moment before construction we get a request and we'll have to shift over to a build-to-suit. But every parcel of land is acquired with the thought in mind to build on spec.
Okay, so you already have a vision and you already have an idea of what kind of tenant you're going to be placing in there, and that drives a lot of the decisions that are made in the development.
We build to accommodate what's called 80% of the market. When you're building on spec, you can't appease everybody. People do have specific requirements that we can't accommodate, but we look at it and say, okay, what is the general requirement for majority of the tenants in the market? And that is high bay, that is access to highways, quick access, a labor pool. So we kind of look at that and check off our list. And if we can hit all those checks with property, we'll then acquire and move forward accordingly with a spec project.
Okay. And so, as you said, in the last year, there's been a huge volatility in interest rates. It increased 22, 23. Now it's been decreasing. Again, with the U.S., there's been a lot of uncertainty. It's just harder to stabilize buildings. And so once you've built and you have it, you need to fill it.
Absolutely.
How creative have you had to find tenants and stabilize quickly?
Well, first, we're starting to see early signs of a turn.
Yeah.
Right? Rates are coming down, not just for developers. The positive in that is that for tenants, they need to be able to borrow in order to make the move. You think of racking, you think of other options that they need. So doesn't just help a developer or a landlord, it helps a tenant moving into the space. Tariff discussions are calming down, which is a big psychological shift for everyone, right? You need that mindset to think, okay, things are going well, we feel comfortable to make the move.
Exactly.
Uncertainty is a new reality, but when you hear those kind of those comments between our Prime Minister and the President of the United States, it helps everyone. We're not in a boom, but you can feel the hesitation is easing. There's more tours happening now, more engagement, deals are getting done. So there's a big change in the market and the perception of the market over the last couple of months, definitely.
I like how you said it, as in it's not booming, but it's stabilizing. Yeah. And it seems like now the level of uncertainty that was so high has just decreased. Yes. So at least there's a little bit more predictability.
Exactly.
This is an industry where, you sign leases for 10 years and those manufacturers, those companies who store I'm thinking of the warehouses, they need to know that they're making a good long-term decision.
Absolutely. And a lot of these multinationals that we work with, they were ready to make a move in 2024. And then
wait and
change.
see.
And then it's exactly that. It's not dead. We will put a pause. We'll wait in the silence to see what will happen. So that pause and wait to see what happened, we're here now. Now we're seeing them say, okay, we got to make a move. It could be increase space, downsize, or consolidate. But there's a move that's being made now.
At least they're making decisions.
Exactly.
And this is what was really hard for everybody is no decision was made, no new investment, and some of the tenants wanting to increase space, but they said no, we're gonna keep more in our existing warehouse, even if it's harder and more inefficient, but we can't sign up for 10 years yet.
That's right.
So,
that's right.
Absorption has been. I'm glad to hear that you're feeling a little bit more now of a spark.
Absolutely. It's nice to see our leasing team touring on a daily basis. It's nice to see our legal team signing leases. It's comforting, not only for us.
Yeah.
It's comforting for our partners.
Oh, absolutely.
And for the banks, right? Because we've had to. We spent the last 6 years building credibility, so that banks could feel comfortable in lending us the capital we need to build on spec, which is very rare in Quebec.
And so now that it's starting to pick up again, if we call this kind of the new normal, what does that mean for your future acquisitions, developments, and the vision for the next couple of years?
I think first and foremost, when you deal with a market that was as unstable as it was, it creates a lot of discipline in everything you do. We didn't chase every deal in the last 7 months. We focus on the fundamentals, which is location, transportation, modern design, and end user demand. Where are they looking to move? What is their requirements? The market forced us to be much sharper, but that's not a bad thing. Cycles make good developers better.
Yeah, it just only helps you to sharpen the blade.
Absolutely.
And then with this in mind, what kind of evolution have you seen when it comes to tenants?
That's a great question.
Because we've felt that squeeze as developers and real estate investors, but on the demand side, tenants have become more, I don't want to say more picky, but have more and different expectations.
I'd say that tenants are definitely more selective, not necessarily smaller. So they want efficiency. They want higher clear heights. They want better speed to market, improved loading, modern specs that lower their operating costs because it's bottom line. You have those benefits in a brand new building. Energy cost savings, quality of life for your staff. In softer markets, the delta between Class A and older stock become more obvious. Tenants might tour everything, but their focus will be on where's my bottom line getting better? Now, yes, your net rental rate may be higher in a brand new building, but when you look at your overall operating expenses, when you look at your energy costs that in our buildings on average are 39 cents a foot, and then you look at the tax credits that people don't really talk about, Laval offers it, the City of Montreal offers it, on brand new construction, not old existing. So I have some cities where our tax bills are $5, but for the next 5 years, there'll only be $1. So that's a huge savings because if you take that tax bill that's $1 for 5 years, and then yes, it'll go up to $5, but that blended rate is still sometimes cheaper than a Class B or Class C building.
And that's an incentive that you get from the city that you've negotiated on the get-go at the build. And does some of it get shared with the tenant?
All of it gets shared. It's passed, all of it, 100% of it's passed over to the tenant. And it's not something we negotiate with the city. It's something that's offered by the City of Montreal, by the City of Laval. They look at it as one, how do you promote?
How do you attract?
How do you attract companies to bring in more labor? How do you attract companies to build energy efficient buildings? Yeah. So the push is labor, the push is employment, obviously, and the push is green initiatives.
Yeah. And they know that it pushes for quality buildings in the long run.
Absolutely.
So it's in their incentive. And it's great because some of the cities are still reluctant to do that.
Yep.
I wish we saw this financial incentive more frequent on the residential side.
Absolutely.
But a lot of cities are still reluctant to that. Again, the market being softer, you have to get sharper with your development.
Yep.
And how you prepare your product, your buildings, and your offering. Now, taking this feedback from tenants, what kind of changes and how have your buildings evolved to keep attracting them and still being sexy?
So, I say it and I'll say it till the day I die, Class A products still win. Even in slower markets, it solves operational problems. Higher clear heights reduce racking costs, better dock configuration, reduce turnaround times. There's all these various factors. We also put a huge focus on site flow, safety, energy systems, and the architectural design. That is huge for us. We put so much time on making our industrial buildings sexy, not just to be appealing, but there's benefits of that to the people who work in these buildings.
Yeah.
Even in a slow market, quality outperforms.
So as it's harder, financing and capital also becomes tighter.
Absolutely.
Let's not kid ourselves. The last, I was going to say 2 years have been a challenge for absolutely everybody in the industry, regardless of asset class, sector, location, and all that. When you were on the show 3 years ago, you mentioned, 3 or 4 years ago, you mentioned that on your first fund, you had gotten about $100 million worth of commitments in 3 weeks.
That's right.
Now I think that $100 million has been spent.
It has been. That was fund one. We're into fund 4 now. Yeah.
Okay.
Yeah.
All the same size?
The third one was over. So the first one was 100. The second was 115. The third one was 265. And now we're working on our fourth one.
Okay, you're working on the fourth one. Again, the capital environment's really changed, and I'm not necessarily talking about debt here, but raising capital.
So raising capital is not the issue. I think the one hurdle that we had at the onset, but fortunately our track record has helped us, is construction financing has always been tougher than traditional financing. Especially Montreal, it's not a spec market. So when you approach a bank and you tell them, hey, I'm looking for financing and we don't have a tenant in mind, it's tough. Fortunately for us, we built an incredible track record over the last 6 years to create that confidence with the banks. We're proud of the projects we're delivering, not because they're big, but because they're thoughtful. And I think banks appreciate that too. And because now we're building on spec, but look what we've done in the last 7, 8, 10, now 24 projects. Banks are saying, okay, it's a financial risk, but it's a calculated risk for us and them. So, and we're very loyal. The banks who've supported us in those spec projects and have seen the return on their own investment, we're very, very loyal to them. So we may not always accept the best rate. It'll be the best partnership for us.
So you mentioned it's been the construction financing that's been more challenging.
Yeah, investors, no, I wouldn't say there's always investors. It's industrial is still sexy.
It's still underserved?
I'd say underserved, but it's sexy. Why? Because the turnaround time is a lot quicker. We can buy a piece of land, go for plans, put up an industrial building, and rent it within 18 to 24 months. Now, if our vision is the same as an investor, whereas we're gonna build, we're gonna stabilize and then sell, an investor's gonna be in and out of a project in 24 months. Multi-res, which we're doing a lot more of now, is a longer turnaround time. If you're dealing with a 4-phase project, each phase can be 2 years. You can be out of there in 8 years. Yeah. Not all investors want to wait 8 years to get their money back.
And so that's helped in attracting capital in the funds. Can you just briefly describe how you've structured them and what's the goal for each one?
Listen, we don't look at projects that have anything less than a 30% IRR on industrial. Now, we'll present probably about 20. We've outperformed that every time. In our first fund, when the market was rocking, we had projects that were doing returns of 125% IRRs. But you never promise that day one.
No.
You want to be conservative and over-deliver, and that's what we've been doing. So we are extremely conservative when we put together pro forma. We never show rents that are $20 net or $19.50 net. We're very conservative. We were actually in brand new products usually below what the average is in the market, and the average is class A, B, C, and D. And our Class A products are usually below what the average is. And that's how we present it to a client, saying, this is what we achieve. And they're like, well, why would you show $15 rents in a brand new building if the market's at $16.50? Yeah. I said, because if we're going to make a 30% return on $15, imagine we're going to make it $17.50.
Exactly. Yeah.
And that's why investors have been coming back to us fund after fund, investment after investment, because we never over-deliver.
On the investors that you've been able to attract, what's usually their profile? Is it institutional? Is it family offices?
A lot of them are family offices.
Okay.
A lot of them are family offices. We have worked with some institutional partners in the past. It's been great, but now it just seems like a natural kind of turn. There's been a lot more family offices interested to invest with us.
Okay. So you mentioned the evolution in your product offering when it comes to now more residential. So you had a big project during COVID. Every time I drive on the 40, I look at your building, and now. Well, it's not that you've stopped. It's just maybe now it's a little bit more on the focus. What's driving this?
So, to your point at the onset, we our first project was a multi-residential project, 207 units in Saint Laurent, called Le 111. We then did a second one in the East End in Anjou called Novelia for 200 units, and we stopped. Why did we stop? Land prices kept rising, construction costs kept rising. Unfortunately, rental rates in Quebec did not rise.
No.
Now we see opportunities. The financial side of things is getting much more interesting. Land prices have come down. Construction costs have come down. Rental rates still have not gone up, but we're able to make good returns for our partners in these cases. Now we're also looking for a multi-res in Ontario and in the States. There's great opportunities there too. So that's gonna be a big part of our business. That's gonna be growing over the next couple of years. Some big announcements coming up in the next couple of months.
All right, looking forward to it. And because as a market, you've really been focused your first few years in the Montreal region. Then you did some industrial in the Ottawa,
correct,
suburb.
Exactly. Yeah.
Now you're also picking up some properties around Toronto.
Not Toronto. We looked at Toronto. There was no opportunity that made financial sense to us.
Okay.
When we do see one. We're not limited by borders. We'll look at opportunities anywhere. It could be Vancouver. It could be Arizona. It could be in Montreal or Quebec City. Wherever the opportunities may lie, we will definitely look at it. It's got to make financial sense for us and our investors. We treat every dollar that our investor puts in us like if it's our own money from our pocket. So we're going to make calculated risks when we have to.
So what's coming on the horizon for Rosefellow? We talked about industrial, and I guess you're going to continue in that direction.
Yes.
Now you're looking more on the residential side.
Both. So I'd say it's going to be I wouldn't say a 50-50 split, probably like 60-40 industrial, 60-40% of our business probably being about multi-residential, large-scale projects, multi-phase projects.
Yeah.
And again, wherever there could be an opportunity, we're not limited by the province we're in or the country we're in.
Okay, and then for those multifamily opportunities, and I'm just thinking of people who are listening who may know land or something like that. What are you looking for when it comes to those residential? Because would you take just greenfield?
We want to build it ground up.
Yeah.
It's got to have all the ideal things you would check off a list. So you got to be in a good location where there's public transportation. You want to be somewhere where you can see the absorption happen. You don't want to be one of 15 projects being developed on the same street because you're fighting for dollars and cents. So it's got to be unique in that sense. And again, it's just got to be, and growing markets as well. We're not about looking in the rearview mirror about what the stats showed us in the past, where the stats going in the future. So we will do a proper analysis. It's all data driven. Everything we do. People think, you just you walk the site, it looks good, you buy it. No, everything we do is data driven, multi-res and industrial, and that's why we've had the success we've had.
And you've had that success because you've also been able to build a great team. Like the company has grown significantly over the last couple of years, even though you keep a fairly low headcount.
Yeah.
And so walk us through a little bit through the various stages that the company's gone through. I mean, when you started with Sam, it was a different animal than it is now.
It's people think we got this huge machine behind us because of all the projects we do. We're developing between 4 to 6 million square feet, and there's not. We're just under 15 people, and why? Because one, we never want to be general contractors. We're going to hire the best in the industry because I don't care what anybody says. Someone who's really good at industrial is not incredibly good at multi-residential.
It's not a builder. It's a different skill.
It's a different scale. It's a different skill. It's different sub-traits, different relationships. I want to have the best on every project. And if you're a general contractor, there's no way in hell that you're going to have your A team on 6 different projects at the same time. You'll have your A team on your biggest one and you work your way down to having a junior project manager on a small project. I don't want to ever have ourselves, our investors, or potential tenants suffer because of a small size project. Hence why we've never been general contractors.
Yeah, makes sense.
And when we hire a general contractor for a job, it's not about the brand. It's about what team is going to be on our project. So if that GC has too many projects going on and I can't get the A team, well, he's not going to get the job. So we've stayed lean because we surround ourselves with the best of the best, and that's the best architects, that's the best engineers, the best general contractors, and that hasn't changed from day one. Sam and I, when we started this company, we said every site we're going to get, we're gonna sit everybody around the boardroom table and look at it together. So it's a white canvas. We have the site, we're under contract. We'll invite the general contractor we think will be best for the job. Same with the architects, same with the engineers and our own construction team, who are not, again, GCs. They overlook the general contractors with their own experience, and we design together. We have a budget in mind. How do we take this budget and design it in a way that it fits the budget? So there's no, we design a project, go to our GCs here, give me a price, come back to me. Oh, it's too expensive, redesign. No. It's done once, it's done right, and it makes sense. And hence why we can keep such a lean team at Rosefellow, and that will stay. As we grow into different countries, we will build a similar infrastructure in every one. But we will always put the focus on who are the best in every market. Because an architect in Ontario may not always be a great architect here, or doesn't have the experience or the know-how. Same with the GC.
Yeah.
So by staying agile, we'll always be able to bring the best around the table.
And it makes sense. As you want to grow in other locations,
yes,
you're also going to have to respect those specificities. And as you were mentioning this, I'm like, yeah, whoever is the best architect and builder here isn't going to be the same in Georgia.
That's right. And may not have the same contacts, right?
No,
exactly.
The same contact.
Yeah, you can get an architect or an engineer in Florida. We're talking with one now in the Carolinas, and they know everybody at the city. You can't get that if you hire someone from here to say, okay, I want to design a project there. They're starting at ground zero. You want to have someone who has a relationship, someone who understands what the city's looking for, what can or can't be done. That's what's value.
As you talk about relationship, and for years I've kept repeating that real estate is a relationship-based business. We now have a new administration in town, one that is known and has been vocal about being a little bit more pro-business. And I think a lot of us are happy about that.
Yep.
How do you see this having an impact on some of the projects, some of the approvals, and working with the cities overall?
I think, again, it goes back to a little more stability in the market. It just helps with everything going on.
Yeah.
We hear it with Carney now, who wants to go back to China and have a meeting there. Hasn't been done in 9 years. You think that's going to create confidence in other countries with Canada? Absolutely. Yeah. You finally we got a prime minister who was able to sit down with Mr. Trump, right? And he's not being mocked. Yeah. There's no deal done yet, but it creates that confidence the market needs. It gives that confidence to tenants to make a move. With regards to cities and permitting, there'll always be cities who will, push back, others who are pro-development. There should be some kind of uniform type of way to get projects approved, but that's not going to happen for the time being. But we are, when we look at sites, it's not only about a great site. We talked about what it takes. It's a great city. And if we can find the most incredible site in a city where the city is not pro-development,
forget it.
We're going to pass.
Yeah,
and it could be stuck to a subway line. It could be stuck to the REM. It could have everything you look for. Yeah. But if you're going to have brain damage with that city, we will pass.
No, exactly. If it takes you 3 years to get a permit, it's not worth it. It doesn't work, and your returns aren't going to be there.
Yeah, exactly.
Exactly. No, and it seems like, again, with the Soraya team and all the impact that it's going to have, it's the beginning. She was sworn in like a week ago, not even. It's still too early to tell, but
it gives confidence.
Exactly. Yeah. And that's such a big driver for all of us to be able to make decisions for the next couple of years.
For sure.
So when you come back on the show 3 years from now, which I hope you'll come back before 3 years, what is it that you want to be able to turn around back on and seen that you've achieved?
It's a great question. It's nice to develop what we develop, and I'm proud of every building we do. But like my goals for 2026 beyond real estate was just to give back. To give back to the young professionals who are contemplating getting into real estate, who are hesitant to make the move into entrepreneurship. I think I'm going to push a lot more for that moving forward. I give back as much time as I can, but for Rosefellow, and we make this a mission to tell everyone, when you can help people, do so. Yeah. We'd love to see Rosefellow grow into, I can't say every state in the United States. There's a lot of states that are pro-business, others are not. But I'd like to be able to sit down and say, we have 24 projects across the United States now. Yeah. There's some in Europe. I spent some time in Asia recently, just understanding how things are done there. So I'd love to be able to come back and say that we've grown outside of, Canada, United States. We've been able to give back a lot more of our time. It is so important for us to do so. If we can change somebody's life just by the message we give and give them the courage to go forward, that's mission accomplished for us.
And one of the ways you've chosen to give back is that you're now sponsoring the women's soccer team.
Women's soccer team is huge. I mean, no shocker, right? Rosefellow, our brand colors are pink. It wasn't by coincidence or just because it said Rosefellow. Yeah. It was because we want to promote women in construction, in development. There's not enough of it. It is a man's world, we call it, but we see so many more women getting into it. And we say, you know what, if we can do our little part and just put a little pink in there, hopefully someone will say, hey, maybe they're open to it. So yes, women in soccer, women in all sports, you've seen the growth. Of course. Yeah. It's incredible to see in hockey and soccer, and whenever we can do our part and help out a little bit, we do so. It's been great to watch. They made the playoffs, so it's fun, and if we can do more, we will.
Yeah, and it'll continue in the long run, and
absolutely,
that's something to be very proud of.
Yeah.
Mike, it's been a real pleasure having you on.
Thank you
today
so much,
and sharing with us what you're up to and your take on the current market. So thank you very much for participating.
Thank you, and it's humbling, man. We did this, like you said, 4 years ago.
Yeah.
We were both kind of starting into this.
So much has changed.
But at the end of the day, what's great is that we're still as humble as we were. That hasn't changed. You can't let anything get to your head, and I think that's a message for everyone out there. Yeah. No matter how big you think you can get, remember where you come from. Stay grounded, because we don't know what tomorrow can predict. We're living it now, right, with the changes.
And the market keeps us humble.
It does.
You could be at the top, and you're top of the game, and you think you're the best, and then two factors change, and then all of a sudden, well...
Yeah. And you can't control cycles.
No.
You always have to be ready. You always, you can control your efforts, you can control your ethics, your discipline, and how you show up for your team. That's what we can control, and that's what we put our focus on. And you know what? We're getting out of this bad turn of this bad cycle.
It's turning.
It is, and I think we're all optimistic about it. So again, thank you so much for having me.
It's been a pleasure. And for all of you who listened, please share this episode with a friend who could benefit from this conversation. Mike has a lot to share. He just did. And it's great food for thought. So you can also reach out to us for the magazine. If you don't receive a copy yet, get in touch with us and we will send you a free copy before you subscribe. There you go. On this wonderful note, keep researching your market, make some offers, and we'll talk to you next week. Thank you.